So hi everyone, we can see that for every time the market forms this candlestick pattern right there, one, and another one is right here, we can see that we tend up to get a reversal or we get a big retracement. So for example, you can see that right here the market was on a clear downtrend right here, but then after forming this candlestick pattern right here called the hammer, the market tends to make a big retracement. And then we can also see that right here we got a short-term downtrend, but still when the market formed a hammer, it ended up reversing into a short-term uptrend. And then it also happened here. You can start to form this hammer and then the market reversed into a strong uptrend. You can see that we got this series of higher high and then higher low pattern, which signifies a strong uptrend. It's going to be like that. Okay, so let us study more about the hammers in this video. So we are going to be looking at the hammer, and this video explains everything you need to know about hammers. So a hammer is a bullish candlestick pattern with a small body and a long wick protruding below the body, and it always has a little or no wick above. Okay, so a hammer is this candle right here. We can see that it has a very long wick, and at the top here there will always be a very tiny wick, or sometimes this wick will not appear. So it can either be a green candle or a bullish candle, or it can be a bearish candle. Whatsoever color happens, it doesn't matter, as long as it is a hammer which is happening on a clear trend. Okay, so it is right here, you can see that is the hammer. So a hammer is very similar to a dragon doji, and the primary difference is that the dragon doji essentially has no body, which means that it has an equal open and close price. Okay, so the difference between a dragonfly doji looks like this. This is a dragonfly doji, but for the hammer it will always have, at least it will always have a body. But for a doji, dragonfly doji, it will not have any body at all in most cases. So we're still looking at the hammers. You can see that here we had a very clear downtrend, and then after forming this hammer, the price reversed into a clear uptrend. Okay, so for every time we form a hammer on a strong trend, we expect that trend to reduce in force, and then we expect a new trend to come in, or at least a big retracement. So a hammer appears at the bottom of a downtrend. Its long wick implies unsuccessful effort by buyers to push the price down, and a corresponding effort by bulls to step in and push the price back up quickly before the period closes. So in most cases, what will happen is that you can find that, for example, in this strong downtrend, what will happen is that at the tip of that downtrend, we shall form a candle like this. But before that candle closes, the bulls will run into the market and then push the price away from where it is right here, forming at first it was this big bearish candle, but then when the bulls come in to put in their energy, they are able to push the price at least almost 70% away from the low, and then it closes up to form the hammer. And this implies that the bulls are having a stronger force in the market at that current time frame or that current trading period. Okay, so this becomes a bullish candlestick pattern. So for every time it happens in a downtrend, we expect the trend to reverse, or we expect a very big retracement. What am I meaning by big retracement? So what happens in the market is that, for example, you'll find that you have a clear downtrend like this. Okay, and then at the tip of that downtrend, we come to form this hammer. So when we form a hammer, we expect the price to make a big retracement. For example, it can come and move up more than where this retracement, the previous one, was, before it can continue down into the downtrend. Or what would happen also is that the price will start to make series of higher highs and then higher lows to reverse into a clear uptrend. Or again, what could happen else is a consolidation. Okay, but all in all, the hammer implies that the trend in force, which is a downtrend at that moment, has weakened. So a hammer candlestick in a downtrend suggests a potential exhaustion of the downtrend and an onset of a new bullish reversal. So that is what we've talked about, and it is what we are seeing right here currently. Okay, and say that the price was on a clear downtrend, and then after forming this hammer right down here, we formed a new uptrend. So right here on this chart, we are going to be memorizing what the hammer is, and then we shall be able to spot some hammers on the chart. So we can see that right on the chart here, we can see that we have some of the hammers, and what you will have to look to is for a clear downtrend first. You should look for a clear downtrend, and then you look for the hammer. And then we say the hammer is always having a long wick down, and then a short wick up, or sometimes no wick at the tip. For example, this candle here is a hammer. We can see that right here we also have this hammer. Okay, and for every time this hammer happens, we get a big retracement, or we get a change in trend. We are looking for another hammer. We can also, that right here we get a hammer. So for example, when you look here, that price was on a clear downtrend, and after forming this hammer, we got a retracement, but this retracement passed where the previous retracement was. This is a previous retracement, but you can see that the price broke through this retracement before it came to make a new low. Okay, and then after forming this hammer again, we made a small retracement, followed by continuing with the trend. And then after there, we can see that right here we have another hammer, though it was not a perfect one as we expected it to be. Right here, this one here is a hammer, and then followed by the trend changing. You can see that now here the trend is changing to a short-term uptrend, followed by a short-term consolidation, and we are expecting a new wave up according to the way the chart is looking. So when you look at the chart again, right here, we want to see if we form a hammer within the market, where should be our entry point? Okay, that is number one. And then number two, should we take the trade as soon as possible? We form a hammer? Of course, we don't do that, because a hammer is not a confirmation candle, but a hammer is there to tell us that a trend is going to change, or the trend is going to make a big retracement. So when you look at the chart right here on the screen, we can see that we have this hammer right here, and it was accompanied by a previous clear downtrend. You can see that our price had dropped for a significant level, and you can see that from there we formed this hammer, and the price reversed to make this short-term uptrend. So if this were weekly candles, so unfortunately these are hourly candles. This is OZJPY H1. So if this was a weekly candle, and then you form this hammer right here on a weekly time frame or a monthly time frame, when you move to a lower time frame, this retracement here will give a lot of pip movement. So that is also another thing to notice. So where is our entry point? The entry point is often, it is supposed to be supported with, for example, you can see the price will drop, making series of lower lows and low highs. And then after reaching a previous strong support level, it forms a hammer. And this hammer, when it is formed, we wait for a big bullish candle before we could make a trade, or we wait for other candlestick patterns. So for example, right here, if this was a weekly time frame, I would wait for one more candle and then look for a confirmation within a lower time frame. So the entry would be around where this line is, and the stop loss is here. So the target would be to go back and fill this gap, which was created by this big drop in the market, but it was unsuccessful. So when we look at the chart, right, again, we can see that down here we formed a hammer right here. Okay, so and we agree that every time we form a hammer, we do not enter the market there and then. Okay, let us start with this hammer right here. We can see that we have a short-term downtrend right here on this time frame, and then we formed this hammer right here. So after forming that hammer, we are waiting for a big bullish candle to come in, because we are expecting a big retracement or a change in trend. So after forming this candle here, we are waiting for a big bullish candle, and this big bullish candle doesn't come to appear, but we create a gap right here, and this gap shows a strong bearish movement, but still it was weakened by this doji, and then followed by a big bullish candle. So this big bullish candle here was the entry point. From here, targeting this new high which was created, it would have been like this, expecting a big consolidation, but still it did not come to work out like we expected, and then the stop loss would be 1.5 of the ATR from where we have entered from. So after making this short-term downtrend, again we form a new hammer, and we can see that there is going to be a change in market, and then we form this pattern. So where would be our entry? Our entry would be right there. Let me clear the chart. This is the hammer formed, and then the entry would be here, and then stop loss, and then the target price is either at this first level of resistance, or at this second level of resistance, or at the third level of this point where the swing low started from. So we are expecting the price to move in this fashion, because it is making clear a higher low pattern like that. Hit our first take profit, slope down, hit our second take profit, slope down, and then it would still continue to come and fill in this gap. So thank you so much for watching this video. Do not forget to subscribe to the channel for more videos like this. My name is Jordan, and see you in the next video. Bye bye.